Now come to the discussion of the shifting to this one, which is the section 2 in that question 3, which is you all the students almost all allowed to do this question and taking much time on that. Then don't do that. This is the do the question within the stipulated time for the question. Okay, this is the I'm starting from the 30 marks of the question, which is the computation of income tax liability offer. You are given based on your pre-seen given unseen question. Come to this. This is the section 2, it's the question 3. Then let me come to what is a requirement of by the examiner and how many marks allocated. This is the question, and in that what is the marks allocated? It's a 30 marks. Okay, then if I have taken 30 marks lamai, in the 30 marks per mark 1.8 minutes, then it's a 54 minutes, which I need to tell don't take more than that. This is a 54. Then afterwards, what's the requirement? It asking assess the income tax liability of CAPL. This is your company in respect of year of assessment 21-22. Even for December examination, the same year of assessment, then you have to do assess income tax liability of given CAPL. Okay. Now, what is this CAPL? Before coming to the question, let me come to what is this CAPL. Now, let me come to this, the pre-seen analysis, which is we have done for the last examination. Then here, this is the pre-seen CAPL. You can, by looking at this, then you can see this is the very much familiar to this is very much familiar to you in the here very much familiar company for you, which is the okay, it is a name Ceylon Ayurveda Private Limited. Then if I have taken a Siddhartha, you are very familiarized with. This is the company which last time, if I have taken the patrical scenario, this is the last time it has tested herbs manufacturing, the agriculture or agro-farming of the herbs in a particular plots of lands, and the not taking their own agriculture products to their manufacturing process, but taking the agriculture, that herbs products from the outside growers, they are manufacturing that herbs in their own factory. That is the scenario. In that, before the question, I need to come for these things. First thing, this is you all know. Then this is the first thing. Name of the company is a Ceylon Ayurveda Private Limited. Then it's a CAPL. This is from your question. Then the principal business activity. Because before applying the tax rates in the question, I need to come for these things. First thing, the company manufacture and sells, as I have explained, is the healthcare products, Ayurvedic, pharmaceuticals, herbal beauty products, and the beverages. This is the principal business activity, and they have 2 plots of lands in Kandy and Padukka. In that 2 plots of land, there are cultivation of the herbs, but according to the pre-seen, it has not provided the details whether they are using that agro-farming produce to the manufacturing or not, but in the unseen, the relevant details provided. And it is other than this lamai, they are doing the export of these herbs. This manufactured herbs, they are exporting. Then agro-farming, manufacturing, and the exporting. Okay. Then they have R&D center, because all these things are in the paper, then I need to take, there is a research and development center. Being a manufacturing organization, especially relevant to herbs, there should be R&D center. Then these are the first informations, and I need to come for shareholding structure. Why? There are questions from the shareholding structure also. When it comes to shareholding structure, now I have explained this too, and when it comes to shareholding structure, it's at 80% family owned. Local, the co-founder is there, 80% family owned. However, there is a 20% owned by a Blue Rock Capital. Who is this Blue Rock Capital? The Blue Rock Capital is the institutionalized shareholder. Is he a local one? No. The international or foreign institutionalized shareholder being a non-resident person. This is the shareholding structure. Then 80% family owned and the 20% owned by a Blue Rock Capital, which is the institutional shareholder, which is the foreign or a non-resident. Okay. For initially, I really need to provide this shareholding structure, and the Blue Rock Capital oversees institutional shareholder or investor being a non-resident person. Okay. Then this information more than enough, and these are the revenue categories. The healthcare, pharmaceutical, herbal beauty products, essential oil and beverages as a tea. Okay. This is more than enough for you to go with the pre-seen, this particular question with the unseen question with the calculation for the 30 marks. Okay. Now let me come to the discussion of the question, and as usual I am taking the question and taking the adjustment separately. Now let me come to the paper. This is the question in here. Now come to the first part of the discussion. Okay. Question 3 based on common pre-seen. Okay. Then in that, what it has mentioned, in addition to the information provided in the common pre-seen in relation to Ceylon Ayurveda Private Limited, the following additional information is made available for year ended 31st March 2022. The relevant, the detailed unaudited income statement of CAPL for the year ended 31st March 2022 is given below. It is assumed that expenses are incurred. Now this is very, very important. Expenses are incurred for the export business and local business on proportionate basis in line with their revenue. Now this part, it's very, very critical for you to remember. The proportionation of the revenue based on the export and based on the manufacturing or a local sale. Now if I have taken, you can see Lamai in here, okay, you can see the revenue as I have shown you, sub-revenue categories given, and also the like in that paragraph given, export sale and local sale given. Then it's easy for you to take the understanding of this. Okay. Now that's on the second A in that first paragraph. Now income statement for the year ended 31st March 2022. Revenue note A and B, which I have shown to you, it has given. Then the cost of sale and other operating income, as usual there is a note. Then other operating expenses, R&D expense, distribution expense, administrative expenses, profit from operations. All these notes, you have to go to the notes and check the adjustments, and we have to adjust. Then the finance income, note 5, finance cost, note 6, and the net finance cost and profit before tax. This is your starting figure. Okay. This is your starting figure, which is the profit before tax. Now thereby, let me come to the answer. While reading the question, I am coming to the answer. Okay, this is the question. Let me start from the business income calculation. Okay, let me erase these things. Okay, now here we go. Then the business income calculation. I have started from the profit before tax. This is the Ceylon Ayurveda Private Limited CAPL 10 and schedules to tax computation for the year of assessment 21-22. In that schedule 1, computation of assessable income from business, it's a 369. This is the figure I have started from that. Now let me come to step by step for this discussion. Then it has given the revenue breakup in each product wise and the revenue breakup in the export and local sales. Now let me come to what's the paragraph under this note 1B revenue. The company sells produce from its own agricultural plots without any processing. Now what it has given? Very clearly given, company sells. Company is not using their agricultural produce to their business. Then its own agricultural plot without any processing to whom? Lamai, third party vendor. As the quality of such produce is not up to the standard to be used in own value added products. You can understand this. They are not using their own agricultural produce or agro farming to their herbal manufacturing business. It's not in the good quality. If this paragraph not there, if they are using their own agricultural agro farming products to their factory as the manufacturing process, then under the first schedule in the particular concession under tax rate you would have to apply, but in here no need because they are not using that. Okay, then the cost of such produce sold during the year 75 million and the sales price of the same was 82. Now let me do this adjustment in here. Lamai, what is this? The totally, this is the selling of what? Selling of the agro farming products. Selling of the agro farming products. Okay, selling of the agro farming, what it has given, it is exempted from the income tax. It is exempted from the income tax as per the third schedule for the 5 years period. This is exempt. Clear? Then thereby it assumed to be this exempt profit also, this has included in the profit before tax. Nowhere around it is included in the profit before tax. Therefore, this 369, it has included this 82 minus 75, which is the exempted gain on the disposal or exempted gain from the selling of the agro farming produce. Then it should be removed from the profit before tax. I am taking it under the assumption that it has included in the PBT. This has taken, let me take this, okay. Then after that, exempted gains profit from agro farming, third schedule. Very clearly I have put my comment, it's the assume that such exempted profit included in the profit before tax. With that thing, I really need to remove that from here, then I have done it. Then go to the question, other operating income, the details given, rent income, dividend, profit on sale of fixed asset, fair value gain on shares listed on Colombo Stock Exchange. We will come to these later. Then the whether to identify these are investment or a business or effectively connected to the business. Then note 3, extract of some of the expenses recorded under administrative and distribution and other operating expenses. Salaries and wages, director fee, provision for gratuity anywhere disallowed, Bad and doubtful debts, if it is provision, disallow. Stamp duty, we need to go and look at nature. Provision for impairment of slow moving stock, it's a disallow. Staff welfare, we need to go through that. Improvement, need to go and apply the section 14 if necessary. Marcom expenditure, section 15A. CSR expenses, anywhere disallow. Depreciation, amortization, fines and penalties, this all three disallow. Then the legal fees, we need to look at the nature. Valuation, again we need to look at the nature. Office maintenance, foreign traveling, all based on the nature we can determine whether it will be allow or disallow. Now come to R&D expenses. In the R&D expenses, salaries and allowances, consultancy fee, printing and stationery, network expenses and depreciation. When it refers to the R&D expenses, lamai, anyway depreciation should be disallowed. Now when it comes to these four, what you need to look at? You need to look at whether this satisfy the section 15. Now in the notes may be the details provided. Then if they satisfy the section 15, then no harm. You can apply the double deduction under 6th schedule, the additional deduction of the 100% you can apply. Okay? Then this is on that. Now let me come to the finance income. In the finance income, interest from debenture, interest from fixed deposit, we will look at being agricultural company then and the manufacturing company doing export also. This is the investment income. But we need to look at any exemptions given. Finance cost, interest on loan, OD interest, bank charges, all these you know for the year of assessment 21-22 only. You shall not apply the provision of section 18. Then you have to only apply the provision of section 12. Why? In the 6th schedule, it has mentioned under the temporary concessions, it has very clearly mentioned for year of assessment 21-22, do not apply the section 18. Restriction on or a deductible amount of the finance cost, you are not going to apply on this. Then first thing when it comes to this, the finance cost, what you need to look at whether this has incurred for the production of income or not, you need to take into the consideration. Details of assets acquired during the year. Then it's the cost given, R&D center separately, other separately. Now Lamai again, if this depreciable assets are there, if such depreciable assets were taken into the research process, that means the expenditure qualified under section 15, then for this one also without providing the capital allowance, you can go with the application of the double deduction. Now if I have taken this 40, 60 and 85 all and this capital work in progress, no, this is not the something used for the production of income. For this one we cannot take the additional deduction. If it is cover the requirement of the section 15, then you can apply the double deduction on this where it has mentioned. You can go with the most specific deduction, it's given in the section 10 subsection 4. Go with the most specific deduction, and this is for the capital allowances perspective. Then therefore let me first do it and come to the question. Okay, then this is on the capital allowances on other assets, this is on the capital allowances on the R&D center. Very clearly in my pre-scene it has given a point, the R&D center directly contribute to the generating of the revenue of the CAPL. Therefore this can be deductible. Then the third adjustment, capital allowances claimed during the year 2021 were rupees 113,235. None of the assets reached their fully tax depreciation level in the 2021. Then therefore, this opening capital allowance as same we can take under our calculation also. Now let me come to that adjustment. Building 20 years, plant and machinery. I'm talking about other plant and machinery 5 years, lab equipment 5 years. Intangible asset, we need to look at whether the useful lifetime has given or not, and the capital work in progress. In the intangible, it's given in the adjustment 5. Intangible assets acquired during the year of assessment include new vendor management system which has useful lifetime of 5 years. Now you can see it has given the useful lifetime of 5 years. That means don't apply the years in the fourth schedule as per the 20. No, don't apply the 20 because the actual useful lifetime of the asset given, then it is 5. Okay, then done. Now let me come to this each by each adjustment. Now I will going to do this in Roman 2, Roman 3 and the Roman 5. Now come to the computation. In there, which is the okay, then capital allowances on the asset acquired during the I have first taken to other. Building 20, plant and machinery, lab, office equipment and intangible asset 5 years. In the question it has given as 5, then the actual useful lifetime. Now these are the answers on that. It has done. Then with reference to the research center, okay, capital allowances on asset acquired during the year for R&D center, then application of the double deduction other than capital work in progress, the section 15 and 6 schedule, and the, as I have explained to you, this is section 10 subparagraph 4, it's satisfying here. Then therefore the application of this, the application of the most specific deduction, and I have mentioned in the preceding, it has very clearly provided which is the the capital from this R&D center, it's a profit generating to the company. Then the 40,000, 60 and 85,000. Now this is not charged to the income statement. These are cost, then thereby this double deduction is eligible for this one. Then the capital work in progress, why it has not taken, then the capital work in progress not eligible for deductible as the double deduction since not satisfy the criterion under section 15. What is it? Research and development expenses meeting the requirements of subsection 1 of the section 11 may be deducted irrespective of whether they are capital nature or not. In this particular expense, it was incurred for the production of income. Now the question is this, the working capital. It is in the capital work, sorry, it's in the capital work in progress, WIP, it is not the use for the production of income, then therefore that cost we cannot deduct. That's why a note has given. Then the capital allowances on opening depreciable asset, that amount we need to deduct. And when it comes to, as I have explained previously, R&D expenses charged to the income statement, it's a qualifying the conditions of the section 15, then additional 100% deduction since satisfy the criteria under section 15 other than the depreciation, then entire this total which it has given in here under the R&D other than this 44, it's a 151,000 total. From that you have to deduct 44,000, then 107,000. That 107,000 you can deduct, but this depreciation you have to disallow. Let me come to that 2 adjustment. Then here one deduction on the under section 15 which is under R&D, and after that depreciation it should be disallowed. Now let me come to next. This one. CAPL has disposed a few obsolete plant and machinery items fully depreciated for accounting purposes during the year of assessment. The total sale price of the said asset, that's mean my total sale price for both assets, the sale price of the said asset was rupees 1,230,000. The details are as follows. This is the sale price. Now we need to compute from this depreciable assets, it's a plant and machinery, then there is a balancing allowance or the assessable charge. Most of the cases, since these are fully depreciated and there may be most of this assessable charge. Then year of purchase 2014 and 14-15, cost is the 50,500. Then one is 18-19, it's a 25,000. Now all the details given, let me come to the computation of the balancing allowance or assessable charge. Before that, in here, the profit from sale of the fixed asset, for this one, it's a profit. You have to remove this from the accounting profit before tax. Now let me come to that those adjustments, which is the profit on disposal of fixed asset. It is in the PBT. I have to remove it from the profit before tax. Now let me come to the computation of the balancing allowance or the assessable charge. Let me come to this working. Okay, this is the working of the calculation. Then here consideration, all of you all know it's a 1,230,000. The tax written down value, it's for the both asset I am computing together. The plant and machinery, it's acquired in 14-15 and the 18-19 cost given. And the cumulative capital allowances claims, capital allowances fully granted on 14-15, 3 years completed. 18-19 it is 5 years. 18-19 given, 19-20 given, 20-21 given, 21-22 we are disposing that. Then for the year of disposal, no capital allowances. Then for this one it's a fully depreciated. For this one there is a balance of the 10,000. Then there is a balancing allowance since the effect of the 18-19 this one, there is a balancing allowance of 8,770,000. This should be a deduction from the business income. Let me come to that. Here we go. Then there is a balancing allowance deduction 8,770. Done. Then the next adjustment, all done. Next adjustment is the rent income. Represents the income received from renting out a part of the warehouse building to third party. Now my rent income. Now what you have to do? You have to determine whether this is effectively connected to the business or whether this is the investment income. Then it is given warehouse, a part of the warehouse building to third party. Then warehouse is what lamai? We are being a manufacturing company. Warehouse is it our investment asset? No. It is our depreciable asset. What is a depreciable asset? It is an asset used for the production of income of the business. Then by renting out the depreciable asset, is it effectively connected to the business or not? It is effectively connected to the business. Thereby, this rent income, this one, 1,250, this should be as it is in the profit before tax because it is effectively connected to the business. Let me come to that, which is a rent income. As per information provided, it is effectively connected to the business, thereby letting off depreciable asset, not an investment asset. Therefore, no adjustment required on that. Then the next one. Now from this, These two we have considered. Here, CAPL has received dividend income 750,000 from one of its investment in the share market. Out of that, 250,000 was declared out of the dividend received per the dividend warrants issued by the company. Then this is 250,000 is exempt dividend received out of dividend income. Then 750 minus 250, it's a 500,000, it's a liable dividend. Then whatever amount this dividend income has included in the profit before tax, first you have to remove it from the profit before tax, and it shall be identified under investment income as liable and exempted. This is the dividend income. This is part of the investment income. It's 750. Then let me come to the investment income. In the investment income, the schedule 2 is a dividend income liable 500,000 exempt under the third schedule para, or dividend distributed out of dividend received. This is exempted. Then here we go with the total. Done. Now the next adjustment. In this, it's a marketing and communication expenses include commissions paid to company staff amounting to 47 million and payment made to Blue Rock Capital for certain brand promotion activities amounting to 13. Now what's the amount of the the marketing and communication expenses? 135 million we have. This is the value of the marketing and communication expenses. Now in this value of the marketing and communication expenses, 135. Now here, it is in the details it has provided, from that the breakup given. Now in the breakup it has given the expenses commission paid to company staff. This is what, this is the internal. Now you need to look at what as the Marcom expenditure we can deduct it. Other than deduct it, can you go with the additional 100% of the deduction? This is looking for, can we take the additional 100% of the deduction? Anyway, this one time it has deducted. Then we need to go for under 6 schedule. Can we go with the additional 100% deduction? Then this is internal marketing expense. No. And the payment made to Blue Rock Capital. I have explained to you, Blue Rock Capital, when it comes to shareholding structure, this is associated person. Then this is in my shareholding, this is associated person. The balance amount, the 75, relating to advertising campaigns carried out on TV, radio and social media. Then these are the mass media advertising years. It's in the definition of the marketing and communication expenses under section 15A. Then, being a manufacturing company, CAPL maintain a local value addition of rupees 75% in the last year. Then what's the maximum percentage? It's a 65. We have more than that on this my products, which I have expenses as the Marcom expenditure. Then therefore Lamai, so this 47 you cannot take double deduction, but it can be deducted because it's incurred for the production of income. Then 13 million you can deduct once, but this 75 in totally you can take the benefit. It is the 75% of the, or 60, more than 65% value addition requirement is there. That's the first one. And the secondly, which is the it's not the internal marketing or marketing expenses done with the associated person, and again it is value is not more than 500 million. then these are the points to be satisfied, then it has satisfied, therefore we can take this 75 as the Markham expenditure, as the double deduction. Now come to this one, which is the here marketing and communication expenses. One by one I have extracted. Commission paid to company staff, it's an internal marketing expenses not eligible to the double deduction, but incurred for the production of income, therefore an allowable deduction. Next one, payment made to Blue Rock Capital. This is a payment made to associated person, therefore double deduction not applicable, but incurred for the production of income, hence allowable deduction under section 11. Done. Now come to the third one, which is other marketing and communication expenses in advertising on mainstream media or social media, including television, radio, print or other outdoor advertising. Satisfy the section 15A less than rupees 500 million. Satisfy the criteria in the 6th schedule, therefore eligible for the double deduction or rather additional deduction. It has deducted once. It has deducted once from the PBT. Now you need to look at deduct it again, giving the benefit of the additional deduction. Okay, now let me come to next, which is the next adjustment. Markham done. Bad and doubtful debts include a bad debt write-off amounting to 3.2 million. The adequate legal action was taken to recover the debt before it was considered. Okay, this is the bad debt written off, and with reference to this, the adequate legal actions were taken. Therefore, this is an allowable deduction. The balance amount related to provision. This is a provision made in respect of debtors exceeding the credit period of 183 days. Provision anyway disallowed. In this is with reference to 3.2, the adequate action were taken to recover, then the legal action taken with reference to this, thereby it is allowed to deduct. It is allowed to deduct. Okay. Now let me do this adjustment and come back to you. Here we go. In that, which is the bad debt written off, allowable deduction, why relevant legal actions are taken. Next one, provision for bad debts, it should be disallowed under section 10 subsection 1b that para 8. It is what we have in the question. Now I am coming to here in the income statement. Bad debt and doubtful debt 17,150,000. From this you have to deduct the write-off, which is the 3 point, where it was here, the 3.2 million, and the balance which is the provision you really need to disallow. Then it is how calculated, 17,150 minus 3,200. It has done. Now the next one, the stamp duty of rupees 346,000 and valuation fee of rupees 950,000 were paid in connection to the purchase of the land by someone in his individual capacity. Can you remember who is someone? Now someone is a shareholder. Someone here is a shareholder. To do the activities of the shareholder, then it has incurred this stamp duty. Then is this a expenditure incurred for the production of income? No, this is what? This is a domestic expenditure. This should be disallowed. Now where it has mentioned, it is there stamp duty 346 and the other one valuation 950, then both we need to consider as the disallowed. Okay, valuation fees to purchase land, it's disallowed. It's not incurred for the production of income, therefore it's a personal or a domestic expense according to the law. Domestic expense. And on the other hand, stamp duty to purchase of land, it is the not incurred for the production of income, again it's a personal expense of Mr. Saman, then therefore these two situations we are not going to take the deduction. Okay, done. Now let me come to next adjustment on that. What's the number of the adjustment? It is the adjustment number 11. Rupees 5.9 million was incurred as an improvement expense for major modification done to a plant and machinery, which was purchased during the year 2019-20 for a cost of rupees 38 million. Now Lamai, what is this one? Very important adjustment. This is an improvement. If it is an improvement, what the section you are going to apply? It is a section 14 you are going to apply. Okay. Then it's given the repair and improvement. Now repair we are not considering. From the 1st April 2021 onwards, we are not considering the repair, but we have to consider the improvement. Improvement charged to the income statement. What is the amount charged to the income statement? 5.9. It has purchased in 1920. What you have to do, you have to compute the previous year tax written down value. Previous year mean 2021, we were in 21-22. Then we need to take the previous year's tax written down value, and afterwards on that this is being a building. It's a plant and machinery, then therefore from the value we need to take the 20% as the correct one, the maximum amount to be deducted. Okay, now I am going to do that adjustments. Come to that here. Now the improvement, before that we need to come to the income statement and check whether where it has charged. Then in the improvement 5.9, the exact amount is there. Now come to the working. Like in the computation of the assessable charge, there is a working for this, the improvement plant and machinery. What's the cost of the asset? 38 million. What we need to do, we need to compute the opening depreciable or the opening tax written down value. Then what is that? It's in the 31st March 2021 or the 1st April 2021 balance. This is the cost, and 2019-20 it has purchased, 19-20, then 2021. Okay. Then in that tax written down value as at 31st March 2021, then it is the tax written down value is 22,800. This is a 38,000 and this is the capital allowances claimed up to last year. Then here we go, it is a 22,800. Then maximum amount of improvement expense from this, what is the amount from this 20%? From this 20% you have to apply. However, but in the actual improvement expense in the P&L, what's the amount charged? This is the amount, is the 5.9 million it has charged. Then there is a disallowable improvement expense, and which should be added to the tax, the depreciation basis of this end of the year, which is the 1340. Then let me come to this one, which is the improvement in the working in the working 2, which is the 1,340,000. It shall be disallowable. The computation and everything we have discussed. Now come to next adjustment. What is the next? which is CSR expenses relating to donation made to Ministry of Health for the purpose of purchasing essential medicine. What is the amount of CSR expenses? In admin, here we go, CSR 4,300. Now let me come to here, the 4,300, any donation it should be disallowed. And what I can do, Lamai, here we go for taxable income. In that, the donation, which is the donation to government, up to the assessable income, you can claim it, then 4.3 I have deducted from here. Then let me come to paper again. Here, the fines and penalties related to payment made to EPF, ETF and the Department of Inner Revenue for surcharge or penalties on several late payments. Then this is again fines and penalties under section 10. It should be disallowed. Now, what is the value of the fines and penalties? It is the 3,300. It's almost, it should be disallowable. Then in the business income, 3,300, it is disallowed. Done. Then what's the next adjustment? Legal fees represent the payment made to the company lawyer for labor tribunal cases. For sure, it should be a deductible incurred for the production of income. Then the legal fee is 1,450. Let me come to the question. In that, the legal fees is an allowable deduction. Okay, legal expenses allowable deduction because it has incurred for the production of income. Then the next one. The staff welfare includes expenses relating to the medical insurance provided to all the staff of the company on equal terms as per the respective employees' grades. Then this is the something allowable deduction incurred for the production of income, and also when it comes to employment income, this is equally applicable to all employees. Then this is the what? It's an exclusion from the employment income also. Anyway, this is the totally allowable deduction. Staff welfare allowable deduction applicable to employees on uniformly basis, not the domestic expense of them. Done. Then the next one, which is the foreign travel expenses relating to a business visit to promote products in the international market, totally incurred for the production of income, Lamai. When it comes to this foreign traveling, in the income statement, the total cost is an what? Allowable deduction. Now come to that one is a foreign traveling, which is which I need to come to here. The foreign traveling, it is an allowable deduction. Where it is here, the expenses incurred for the production of income, therefore it is an allowable deduction. Done. Then what's the next one? We are in the last few adjustments. Then R&D expenses were incurred in relation to the process of developing the company business and improving the production process. This is in line with the provisions of the section 15. We have taken the relevant part, the additional deduction of the 100%. Okay, done. That part we have already completed. Then the next one, interest income received in foreign currency amounting to rupees 2.6 million was included under the interest income from fixed deposit. Now you can see what's the examiner given: interest income received in foreign currency. Total is in the foreign currency, not the part, total. Then in that it's amounting to rupees 2.6 million. It's a, if I have gone for the note, which is the, let me come to here, in that finance income, interest from debenture, interest from fixed deposit 6.5. Now in the question it has provided on the exempt dividend also the details. Then in that sense, when it comes to this exempt dividends in the note, exempt interest in the note, it has given from that 6.6, 2.6 was incurred on the foreign interest which received under foreign fixed deposit. Then therefore it is exempted. Anyway, this total debenture interest and the total interest income on FD 7,000, first we have to remove from the profit before tax. This is there. Its removal from the profit before tax, it shall be recognized under investment income. In the investment income, as per given in the question 2.6, it is the exempt part, and the foreign currency being a foreign currency, and the balance, the interest income from fixed deposit is the LKR 6,500 into or reduced by 2,600. This is where 6,500, from that what's the exempted part we have to remove. It's the, which is the 2,600. Done. Balance liable on debenture, it's a total 500,000, it is liable. Completed. Then the next one, gratuity paid during the year of assessment amounting to 6,235,000, very clear. Then the provision is there, we need to take the gratuity, this is interest income, and the gratuity payment, here we go, 6,235, this shall be deductible. Now what's the next one? In the paper, brought forward losses rupees 14,570 relating to export profit were reflected in the previous year's income tax return of the company. Now you have to take the business income attributable to the export income and business income attributable to the manufacturing income. From that business income attributable to the export income, you have to remove this loss and take the tax rate. All the adjustments considered, Lamai, but now I need to come to the income statement and the particular notes to take the balance. This one we have done. Revenue we need when applying the tax rate. Then the rent income considered, dividend considered, profit on sale of fixed asset considered, fair value gain on shares 7,700. This is the fair value, that's mean it's a, for the listed shares, it's a not the actual one. Then therefore this is a notional entry. This shall be removed from the profit before tax. Okay. Then the next one. Then all this note 2 we have considered. Salaries and wages allowable direct fee, provision for retiring gratuity, which is a 31,235, it shall be disallowed. Any provision, it should be disallowable. Done. Then the next one, which is the bad debt and doubtful debt, done. Stamp duty, done. The provision for impairment of slow moving stock 27,700, it should be disallowable. Completed. Then the secondly, staff welfare adjusted, improvement done, Marcom done, CSR done, the depreciation and amortization 430 and 6,000, we have to both disallowed. Then depreciation, fines and penalty done, legal done, valuation, office maintenance, foreign traveling done. All the details from the question, Lamai, other than this revenue breakup, I have extracted. Now let me conclude the question. I have taken the plus side and I have taken the minus side, and the minus side taken into here. Then assessable income from business, it has taken. Then there is a business loss, export business. I will take it separately. Then let me come to the apportionment of the business income. In the apportionment of the business income, how? In the question very clearly the examiner provided the breakup. But lamai, when it comes to revenue, now local sales, in local sales that exempted sale also included. What's the value of the exempted sale? This is 82 million is there. Then you have to remove it first. Now let me come to the question. Apportionment of the business income based on the liable turnover. We have the total turnover given in the question 3,141,000. From that, what I have done, assuming that in the local sales, this 82 million included. එහෙම වෙන්න ඕනේ කියලා assume කරලා තමයි ගන්න. එහෙම වෙන්න ඕනේ නැත්නම් මෙතන local sale included in the local sales, it should be there. It's how that total turnover will come. Then with the assumption, I don't know, but with the assumption you can see my computation. It's a total turnover 3,141,000. It's minus 82. It's exempted turnover. Then this liable turnover, which is local and export, I need to divide on this, not the exact amount given in the paper. Now let me take on export on manufacturing. Why we need to divide this export at the rate of the 14%, manufacturing and selling at the rate of the 18%. Then when it comes to export, need to take the business income before the loss 142,561 is divided by total liable turnover and take the particular turnover relevant to that export. Export no change, then it's the 61,480. From this in the paper it has given from export with reference to that there is a business loss. Here we go, there is a business loss 14,570. Then this business loss you have to remove from the, it's a deduction from the business income. Then therefore I have taken that, and what's the export? That accessible income from business from the export is the 46,911. Then the next one, business income divided business income, which we have computed in totally. Then to take the manufacturing and selling part, then total turnover as we have done here, it's a 3,059,000, and we have the now here it's different. What's the difference? From the local sale I need to minus 82, because from the in the local sale in the question it has given even the breakup in here with the exempted revenue. Then therefore I have taken that balance, then divide in the 82. Now I have the 81, which is the total turnover. Now you can see my total turnover 3,059,000 lamai, it has separately divided to 2, removing the exempted by the local. After removing that, each for component 3,059,000 is tally, it's agree. Everything good. Now I have done according to the examiner's details the apportionment of the business income done. Now let me come to the investment income. Then it's the investment income, dividend and interest. I have taken the total. Done. Now let me come to the application of the tax rate on the balance. Before that, in the business income, let me conclude the business income. From total business income according to working less business loss on export part, we have to take in the first thing. Then accessible income from business, this is that 127. Then exempted business income, we have to show it separately. Then assume that accounting profit equal to exempt business income. Then total I have taken like this. Now come to the application of the tax rates. Now we have dividend income, we have interest income, export income and manufacturing income under business and the investment. Then I am going to apply on export 14%, manufacturing 18%. Where I have taken these two lamai is in here. Our calculation 46 and 81. Then it's a 14 and 18, that two rates. Secondly, interest income from the fixed deposits and debentures, it will be taxed at the higher rate, and on dividend will be taxed at the 14%. When applying the qualifying payments, what I have done in the assessable income, it has not given a restriction to apply it to the what assessable income it has not given. It's given deductions from the assessable income. Then it's from the total assessable income. Then whatever the good method you can go and apply. In the tax planning perspective, I have deducted this from the 24%, the higher tax rate. If not, logically, this is given from this business, එහෙම හිතලා you can on the proposition of the revenue, you can take this under this, or else you can allocate this to among this for whatever. But in the section 52, it has very clearly given the deductions from the assessable income. It has not given which assessable income. Then normally in the tax planning perspective, we are taking it for the higher rate. The same thing I have done, but students are free to take this dividing by this one or whatever the method they can take. Okay. Then my total tax liability 21,256. Then come to my taxable income. I have taken the business income, investment income, no other income. This is my total assessable income. Then this is the deduction of the qualifying payment. This is my taxable income. Then tax on taxable income in the third schedule, it has taken then my tax liability and the balance, the income tax payments not given, then the balance tax payable also this. This is the end of the discussion of the section 2, question 3. The first part, the 30 marks question. Lamai, this is comparatively for the previous, this is a very easy question for students. If you have done this properly, entire this 30 marks you all can take. Okay. Now let me finish off the discussion of the question 3, part A discussion. Now let me come to the same question which is in the question 3 in that part B discussion. Now we have completed the 30 marks question on the computation part. After that, now the balance 20 marks, it's total with the writing part. Okay, now come to this one. Part B, let me come to the requirement first. How many marks, Lamai? It's for the 5 marks given. The 5 marks given for this. Therefore, let me analyze one by one. What's the action verb? Is the assess. In that, assess whether CAPL can deduct the payment made to the the payment. Let me take one by one. It's a payment. Then, made to the consultancy firm. When computing the income tax liability for year of assessment 1920. We are doing the tax computation. We have done it for 21, 22. But in the question, it is asking something we have done past, and today we need to assess whether what we have done is correct or wrong. There is a payment which we have made to the consultancy firm. Then how you should answer on this, Lamai? This is the requirement by the examiner. You have to assess based on the first one, provisions of the Inland Revenue Act. Second one, support your answer with decided case laws. By taking this, if you can do this, then 5 marks can obtain. Now, let me come to the requirement of the question. It's a requirement we have discussed. Let me come to the facts of the question. Okay. The Department of Inland Revenue, DIR, conducted an audit of CAPL for year of assessment 1920. Very true. For this year of assessment, 1819 there are assessments. 1920 there are many companies, there are audits conducted by the Department of Inland Revenue now. And the Assistant Commissioner highlighted following points. What's the first one? An amount of rupees 1.25 million, 125,000 million 25,000, not million, was debited to the income statement. Okay, it's debited to the income statement, that means it is expense. This amount was paid to a consultancy firm for obtaining advice by someone. Who has taken the advice? Someone, the managing director of the company, in his personal capacity, not the company. This is in his personal capacity to get an understanding of the tax implication and the regulatory requirement with respect to the proposed sales of his own shares to Blue Rock Capital. Then the Assistant Commissioner has disallowed this expense, stating that it does not relate to the production of income of the company. The Assistant Commissioner noticed that the shareholding structure of the company has changed in the 2021. This is thing. Then based on this information provided, what you have to do, Lamai, you have to assess whether CAPL can deduct the payment made to the consultancy firm. Okay, now let me take this one. Okay, to deduct the payment, then what we need? To deduct the payment, we need, now it's the payment. This is a subject matter to done to the consultancy firm. This is the subject matter, consultancy firm. On what? To take the advice, obtaining the advice under the personal capacity of Mr. Saman, to know that the implementation or the implications of this changing of the shareholding structure. Now come to here. To deduct the payment or to deduct the expense. This has charged to the income statement. In the tax perspective, to deduct the expense, what are the criteria to be satisfied? There are two. In the section 11, it has given income shall be incurred for the production of income. Incurred for the production of income. And it should not be, that means relevant year of assessment, it should be incurred for the production of income and shall not be capital nature. In this scenario, this is clear, Lamai. This is not the capital nature. This is clear. This is not the capital nature. Shall be incurred for the production of income of the company. Now our organization, you can see our organization is in the business of what, Lamai? Is in the business of the manufacturing and selling herbs to the local and the export market. Then this, is it incurred for the production of income of the business? No. Why? This is incurred for the purpose of the personal matter of director. Therefore, this is actually not incurred for the production of income. The expense shall not be remotely connected. It should be directly connected to your business. Then the Assistant Commissioner's opinion is correct. And again, when writing your answer, you have to take the benefit of the case law provision. What is the case law? It's in the A.W. David Appuhami case law, which is the Candice, in that for the shares, to secure the benefit of the shares of that particular shareholder, he has taken the advice. Then on that, is it deductible or not? The same kind of the scenario. Then the David Appuhami, that case law you have to apply. Now let me come to the discussion of the answer on here. Then this is, I will just take the answer format I have given. I really need to come to this typical points. It's asking as per the provisions of the Inland Revenue Act and the case law. Now the application of the Inland Revenue Act as explained, the theory, section 11, the provision, this is theory application, and as per section 11 subsection 1 main deduction rule of the Act and its amendment, in calculating person's income from business or investment, the expenses to the extent they are incurred during the year and for the production of the business or investment shall be deducted. Done. Then in that, also in terms of the section 11 subsection 2, capital nature shall not be deducted. Now I am coming to my major part of the answer, which is the application. Application. However, consultancy fees paid to obtain of tax advisors in the personal capacity with reference to the get an understanding of tax implication and regulatory requirement on the proposed sale of Mr. Saman's own shares to Blue Rock Capital. Institutional share is different from the principal business activity of CAPL. You have to write these things. Then you have to confirm it has not incurred for the production of income. Secondly, further, such expense, which is a consultancy fee incurred to obtain personal understanding of the proposed strategy, not relevant to the business, and it would not have an impact on the profit generation of the CAPL. Clear? Then these are the application and expenses not incidental to the business but too remote. Clear? These are the key points you have to highlight, Lamai. Now, definitely you have to apply the provisions of the case law. This is that, as I have explained, the AW, the David Tappuhami, which is a candy ice case, I am not referring to all. Then I need to come to the conclusion. In the conclusion, accordingly, recommendation conclusion, the Assistant Commissioner's opinion is correct. This is what we need to tell. Then, and the consultancy fee of rupees 1.25 million debited to income statement shall not deductible when arriving into the taxable income, as it is not incurred for the production of income. Clear? For this 5 marks, if you have write like this, entire 5 marks is awarded to you. Okay? Then it is the end of the discussion of this 5 marks question. Then, okay, let me come to next. In a part B, second one. Okay, it's how many marks? For 3 marks. Advise, this is the action verb. Action verb is advise. The shareholders of the company are on the applicability method, on the first one is on the applicability. First, method of calculation. These are the things you have to provide the advices. Due date of making payment, third one. Fourth one, and filing of the return. In relation to what now my capital gain tax, can't you write this? For 3 marks, entire 3 marks, straightforward you can take. As a result of the changes in the shareholding structure per the relevant provisions of the Inland Revenue Act as the amended. The 4 requirements for 3 marks, let me analyze one by one. First one, the advice to the shareholders of the company on the applicability of the capital gain tax. The first one, which is the applicability of the capital gain tax. Application of CGT. On what lamai they are asking the changing of the shareholding structure. This is the disposal of shares. Disposal of shares. Shares is what? Shares are the investment asset. If a person has invested in the investment asset, then our example is the shares by disposing of the shares. Disposing of such shares, but other than the quoted public company shares, it is liable for the capital gain tax. That's the application. Since they are selling the shares, selling of an investment asset, then it is applicable. Secondly, method of calculation. How to calculate? How to calculate the capital gain? Then I'm coming to the method of calculation. Then how to calculate is the consideration minus cost. Consideration minus cost. Now the consideration at the disposal and the cost. When it comes to the cost, you need to tell this is the 30th, the valuation, 30th September 2017 valuation. We have to take it or not. Based on the information provided, the shares were invested by the Mr. Saman in 1997. That means it's a prior to 30th September 2017. Then you have to take the valuation on that. Okay, you have to take the valuation on that. Then the plus any incidental expenses on selling you have to take, that's the calculation, the application of the section 36, 37 and 38 you have to take. Done. And the dates of making the payments and return filing, very easy. Date of making the payment, due dates for making payment and the filing of the return. What's the due date of the making the payment? It's within 30 days. Within 30 days from the calendar month, from the end of the calendar month, which is the end of the calendar month with the transaction happen. Calendar month with the transaction happen. With the transaction happen. Okay. Then this is the due date of the payment within 30 days. It's a 30 days. No, yeah. Within 30 days of the end of the calendar month which the transaction taken place. If the transaction taken place on 15 January 2021 or 2022, then it's the end of the calendar month 31st January. From that, the 30 days, it's February 28th, 29th, sorry, not 29th, it's a March 2nd at least, okay. Then it's a filing of the return also the same due date. Payment and the filing of the return, it's the same. This is for the 3 marks. I'm not going to take much time on this. It's very straightforward. Explain all. Okay, it's for the 8 marks that part. Now let me come to next, which is the part C, options. As a usual question, options given and you have to evaluate the option. For how many marks? It's for first part, it is the 7 marks. Okay. Then how it 30, that 8, 7 and 5, 50 marks done. Now come to here. 7 marks. First I will take Roman 1 in the part C. In that, what you have to do, you have to evaluate the 2 proposals. You have to evaluate, there are 2 proposals given above by discussing the following. The format of the answer given. It is the income tax incentives, second one applicability income tax rates, income tax exemptions and income tax concessions 2, 3 and 4. You have to evaluate 2 proposals separately for 7 marks by telling the income tax exemptions, applicable income tax rates and concessions if there is any income tax incentives together. Okay. Then let me come to the explanation of this by reading the question. Okay. For the first 7 marks. As stated in the pre-scene, the company expects to list its shares on the Dirisavi board next year. Fundraising from listing the shares are expected to be used in increasing production capacity related to exporters. That's the thing. Under that meaning, what has happened, it is proposed to have two investment options. The two investment options to expand export sales and minimize the cost of production. The two objectives, expand of the export sale and the minimize of the cost of the production. What are these two options? Option 1, invest rupees 750 million, US dollar 2.5 million in a new company, very important, in a new company to produce herbal beauty products and essential oil to export market. Now, before going for the option 2, before going to the option 2, let me come to the analysis of the option 1. Okay, this is the invest rupees 750 million, is a US dollar 2.5 on the new company to produce herbal and beauty products to the export market. Let me come to the analysis of this. Okay, then come to here. The analysis of the option 1. In the perspective of what they are going to do, incorporate a new company, for what? To manufacture herbal beauty products. It is the new company produce herbal beauty products, and for export market. Now let me tell, I will take the easy points for me, Lamai. First thing, if it now in the, we have to analyze two things, Lamai, on this option 1, on tax rate, and what's the second one, which is on the tax concessions. Concessions mean exemptions and all. This is to answer structure. You have to put these things. Since it's export market, I'm taking the tax rate directly 14%. Lazy again, Patanga is a 14% under the first schedule. From the gains and profit of that, the merchandise and all these things, if received in foreign currency, then it is a 14%. Done. The first schedule, subparagraph 4, in that subparagraph 2A. Okay, this is the rate. That part done. Now the concessions. Now Lamai, what is the investment on this? For this one, to manufacture this herbal, it's a thing is the given in the question 750 million in LKR and US dollar 2.5 million. That's all. Then it's given to come in a new company to manufacture herbal beauty products. Now, concession. What are the concession we have? We have second schedule and we have sixth schedule. Then, my question is, Lamai, can we now, we have to look at, can we apply the second schedule? No, we cannot apply. Why? My investment is less than US dollar 3 million. Then if it is so, can I go with the second schedule? No, eliminate that, but by telling you are going to eliminate it. What is in your mind? Then therefore, the sixth schedule can be applicable. Why? It's a US dollar less than 3 million, 2.5, and it is not the expansion of the existing business. Why? It is a new company. Very, very important. It's not under the umbrella of the CAPL. They are going to incorporate a new company and start this for the export market. Then the very clearly my 6th schedule you can apply, and what's the time period? Only 6 years you can claim. If you are starting immediately the 20, this is proposed on the 21, 22, then if it has started 22, 23, then it's from the can apply. 18, 19 from the it's effective from the day of the act taken into effect. Then it is Act 2018, 19, 19, 20, 20, 21, 21, 22, 22, 23 and 24, 25. If they have done, they can apply this. Done. This is the evaluation of the first option. Now I need to come for the evaluation of the second option. Okay. Now let me come to that. In here, evaluation of the option 2. Let me come to option 2 and I will explain like that. Then acquire 100% ownership of an existing company. Acquire 100% ownership of the existing company. What is that? Hellosu Private Limited, HOPL, which is engaged in the business of cultivating herbal plants and processing the same for use of the manufacturing process. Now what they are doing, very carefully read this. What they are doing, business of the cultivating herbal plants. First one, cultivating. Cultivating means what, Lamai? Agro-farming. Keep in mind, they are doing agro-farming. Cultivating herbal plants and processing the same in a manufacturing process. Agro-farming, after that, process for manufacturing. Then here, farming is what, Lamai? Exempted from income tax. Manufacturing, the rate is 18%. But if they are using their own agricultural products to the manufacturing, then there is a reduction of the tax rate. 25%. Reduction of the tax rate as per the first schedule. You have to take all these things into together. And done. HOPL is one of the main raw material supplier of CAPL when it comes to the producing herbal beauty products and the essential oil. This is not telling they are going to take this under new incorporation or new something. It's 100% acquisition. Therefore, it's taking under the umbrella of the CAPL. Therefore, any benefit under the 6th schedule and the 2nd schedule shall not apply. This is the expansion of the existing business. Expansion of the existing business, this shall not be applied, but with reference to tax rates, you all can apply the 18 or the exemption and the reduced rate under the 18 based on their business model. And HOPL has brought forward tax loss incurred during the year 18-19, rupees 125 million. The expected investment for the acquisition of HOPL 500 million and the other 250 million on the expansion of the existing capacity of the business. Anyway, for this one, since it's under the name of the CAPL, going to take the 6th and 2nd shall not apply. Based on their business module, agro-farming is exempted, and if the same agro-farming, same they are produced, is used for the manufacturing process, then it is the reduced tax rates we can apply. Now, let me come to this one, income tax rates and the application of the income tax incentives with reference to second option. Now I have explained it, but I need to come for this one. Okay? This is on capital gain and the option 2. Option 2, which is the acquisition of 100% ownership of an existing company engaged in cultivating herbal plants and processing growing by the initial investment of the rupees 500 million. The tax incentives, the application of the second and the sixth schedule shall not be applicable, since this is expansion of the existing business. This is the application. Done. Application of the income tax rate. I need to come for this one. The new company, this is it's a 14% tax rate under first schedule if the gains and profit are from agro-processing. Agro-processing 14, we don't know. If they are in the business of agro-processing under the definition of section 195, that's why I have taken these different angles you have taken. Whether they are doing agro-processing and farming and the manufacturing may be agro-farming, this thing. Now it has, according to this law, then it is the agro-processing, what's the definition it has provided. Then the next one, I need to come for this one specifically. However, as per para 11 of the first schedule, tax rate for persons who engage in agro-farming together with processing or manufacturing. What's the reduced tax rate? Where a person utilizes agro-farming produce produced by him for his agro-processing or manufacturing business, such portion, what's the amount you are using only for that, such portion of the tax payable in respect of such agro-processing or manufacturing business activity, the correspondence to the proportion of the farming produce, there is a percentage to divide, to total farming produce utilized such agro-processing or manufacture shall be reduced by 25% for the period of 5 years with effective from 1st April 2021. If they are doing agro-processing, 14% reduced by 25%. If they are doing manufacturing, if so 18% reduced by 25%. Based on information provided in the question, it was noted that HOPL cultivating herbal plants and processing the same for use of the manufacturing process, thereby company get with the agro-processing which is on agro-farming, accordingly above concession can apply. This is the theory part and this is the application of that. Okay? Then the next one, income tax exemption on what? Agro-farming. HOPL is the business of agro-farming. The three things you have to take, processing, farming and manufacturing. Then with the definition of section 195, company shall apply the exemption under third schedule, para U in that Roman 1, the gains and profits earned for derived by any person from the sale of produce from agro-farming, it is exempted from 1st April 2019 for how many years? It has 5 years given. Still, in the question we are in the 5 years period. Since HOPL will be in that business, this is the theory part, this is application. Since the HOPL will be in the business of cultivating of herbal plants, they can apply the exemption under third schedule. Okay? Then this is for the answer of that part, the evaluation of the two options. Clear? Now let me come to the paper. In the paper, the 7 marks we have done, the 7 marks completed. Now come to the last 5 marks of the question. What it has asked, action verb is explain. In the explain, the ability to claim available tax losses by HOPL divided in the sub requirement and the applicability and disclosure requirements in respect of the transfer pricing that may arise under option 2. Okay, there are two requirements. Let me first come to first one and explain. First one, explain the ability to claim, which is the available tax losses. To claim available tax losses, what has happened now? HOPL is there. Their ownership 100% transferred to CAPL. 100% transfer to CAPL with compared to the 3 years of the ownership from the immediately change in year. Okay, what is this application of the section 63? Section 63, which is the changing of control. Okay, then in that sense, accordingly, there are 4 things: business loss, finance cost, the amount to be reversed, and the particular that long-term contracts and all. It shall not be claimed after the change in of ownership if the ownership has changed more than 50%. In our case, yes, ownership has changed more than 50%, accepted. And the question is, can we claim that business loss? In the question, it has given there is a business loss. There is a business loss of 125 million. The question is, can we claim that? Yes, Lamai, we can claim that. In which situation? We can claim it if the same business we are continuing at least for 2 years after the exhibition, immediately, at least 2 years, if we are in the same business of our case, manufacturing, agro-farming, processing and manufacturing, same thing is done in the HOPL. If we are not breaken, if we are continuing that, then business loss we can claim. That's what you have to write. Okay. Now let me come to the particular points of the answers. Then okay. Let me erase this first. Then in that, the applicability to claim available tax losses, which is brought forward from 2018-19. Then the loss claimability requirement, 6 years, 18-19, 19-20, 20-21, 20-21, 21-22. We are still in that particular claimability period of the 6 years. Then here, according to the section 19, explain. Secondly, however, as per section 64, in here I have mentioned as section 60, section 63, I'm really sorry, it should be section 64. Then when the underlying ownership of the entity changes by more than 50% when compared to the ownership at any time during the previous 3 years, the losses relating to previous period to the ownership changes of such entity cannot deduct the particular losses unless the entity conducts the same business, which I need to really emphasize is this, unless the entity conducts the same business for the period of 2 years after the ownership change. In this scenario, it is proposed to acquire 100% of the shares of the HOPL. Therefore, it falls into category of the change in of ownership of the 50% application. Then the next, As per the information, it was noted that HOPL is planning to continue the same business of cultivating herbal plants and processing as the same even after the changing of the control. It has mentioned that subsequently expected to invest 250 million on expansion of the existing business. These all details, Lamai, I have extracted from the paper. The application of the given scenario. If the HOPL continue with the existing business for a minimum of 2 years, after the ownership change, it can claim the brought forward tax loss as mentioned in section 19. Then, however, in any case they are not going to do so, then you cannot claim the business loss. This is on that first part. Okay. Now, let me come to in the question 5. For the 5 marks in the part C of this question, in the Roman 2 part, in the explain, the claiming of the tax loss done, and the applicability and the disclosure requirements in respect to transfer pricing under option 2. To apply transfer pricing, what should be there? There should be first one, associated person. Not only associated person, Lamai, second one, there should be transactions in between associated person. Transactions in between associated person. Even there are associated person and transactions in between associated person, we cannot tell there are application of the transfer pricing. To come up with the application of the transfer pricing, according to the Gazette, in the regulations, there are 3 requirements to be satisfied. What are the 3 requirements? First one company making losses, other one is not. Second one company is exempted, other one is not exempted. Third one company is at the, or 2 companies is taxed at the different tax rates. Different tax rates. Then if these things happen, yes, of course, there is application of the transfer pricing. Now in our case, after the exhibition, CAPL and HOPL, these 2, there is a, it's very clearly given there is a one has loss, exemption and the different tax rates also. Then highly transfer pricing is applied for that. Then disclosure requirements. When it transfer in the agro produce to the factory, it should be now with associated person, it should be at arm's length price, these things should be disclosed, and any transaction with reference to this associated person, it should be disclosed. And not only that, if the transaction value is more than 200 million, you should file what? The transfer pricing disclosure form. Okay. Now let me come to the further explanation on it. Very hot topics, then therefore even this time please go through these things. Then the applicability of the transfer pricing, I have not come into this A, B and C because I have explained it, losses, exemption and the different tax rates, but I need to come to here. The disclosure requirement, the categories of transactions in between CAPL and HOPL, supply, purchase of raw material for producing of herbal beauty products and essential oil, and pricing. The value of above transaction, the application of the most transfer pricing method, you have to mention. And if again, if the transaction is more than 200 million, then you have to go with the transfer pricing disclosure form. TPDF you have to file. Okay. Then this is the end of the discussion of the total question 3 of the part section 2. The part C we have done option evaluation. Part B we have done, it's on the case laws and the application of the capital gain tax, and the thirdly the calculation. Everything in the section 2 we have completed comparatively very, that means all the students can attempt to this question very careful if they have done it. Very good question from the side of the students. Okay. Now with that all, let me finish off the section 2 question 3 fully.